Hello, everyone. I'm Deborah Drake, and I'm really pleased to welcome you to our session, which is tackling and learning from past crises in terms in tackling COVID. We're really looking forward to our conversation today, and it will be a conversation. Um, I want to tell you a little bit about what we've been working on in terms of learning about these past crises. We think we can learn a lot from them. I think the three of us have all been involved in them, and we think that by learning them, we can really, by studying them again, we can really learn a lot about weathering the storms. So what we've learned in the past from past publications is that there's a lot of components, important elements that we've learned over the past that will make a microfinance institution resilient and being able to face challenging times. So we're here to talk a little bit about some of those past crises and to answer any questions that you may have and to really share a little bit of our experiences. So this isn't a formal presentation. It's very much a conversation amongst myself, Deborah Drake, Daniel Rozas, and Donna Nails. To give you a little bit of background of who I am, I work for the Center for Financial Inclusion of Acción. I have been leading the governance and investor efforts for many years, and very specifically, I direct the Financial Inclusion Equity Council, which is a membership organization of private equity funds investing in financial inclusion. So all of our members and my members have gone through a lot of crises in the past. And with governance, I've been running and directing a program called Board Leadership for Impact, which really looks at the roles of board directors and shareholders in keeping their institutions strong. So they are also a very important part of the ecosystem of crisis management. So I'm very proud to be working with Daniel of the European Microfinance Platform that's been part of this project to look at past crises, as well as with the MasterCard Center for Inclusive Growth. So I'll have my two colleagues introduce themselves, and then we'll kick off with just a topic that I think we think everyone is going to be very interested in terms of what's happening now and how we respond to this crisis. So Daniel.
Hi, Deborah. Good to see you. Yes, indeed. So we started, in fact, when we talk about learning from crises in the past, we're talking about the deep past, well, deep in a relative sense. It was, in fact, I think 12 years ago or 11 years ago when we first started collaborating with Deborah on the Weathering the Storm paper, which was looking at MFIs that had gone through crisis both during and before the financial crisis. So this is some of those cases went back to 2004, 2005, if I remember. And it was also our idea as when COVID started to revisit this work and also see could we find additional cases that would be particularly relevant to COVID. And that's kind of the new work that's going out now, and you can see it on the CFI's website. Here, it's our opportunity to chat and reminisce and talk about something relevant and useful, not just about those cases. I think the key for me is, if I remember right, the first paper had a quote from Eleanor Roosevelt that said, Take the opportunity to learn from the mistakes of others because life is too short to make them all yourself. So with that in mind, off we go.
So my name is Donna Nails. I am based in Sarajevo, and my background is that, my first crisis was working in Bosnia in 2009 and 10 during that first economic crisis. But subsequently, I've been in Azerbaijan with the currency devaluation, and I will never forget this date, December 21st, 2015. I've also worked a lot in Palestine when we had some crises in Gaza. So I come from the standpoint, I should say my background before that was I was in banking, small business lending, and risk management. But I come very much from a hands-on, inside the MFI, working. A lot of times investors or the MFIs will hire me to go in there and assist them during and get them through this crisis, understand what's happening to their balance sheet, their portfolio, and kind of looking forward of how we can get through the crisis and come out whole again in the end. Or maybe sometimes in Bosnia's MFI case, we came out half, 50%, but now they are back to being as big as they were before. So thanks.
That's great. So you can see here that the focus is on the practical, the focus is on what have we learned, and actually, what can we do now? There's nothing better than looking back in the past and seeing, a role model of something that worked, because you then you may want to kind of follow what they've done or what someone has done. And then there are those role models that haven't worked, and you want to avoid that. And so that's really what we're here about, is that we're in the middle of this COVID situation, the pandemic. You've heard this week, I think a lot of discussion from investors as well as MFIs, a lot of talk about liquidity, where do we stand? There's this sense, I think, shared by many, that we're in a fog. We're not sure where we're going right now. There's not enough information. It's just very unclear. So, how do you cut through some of that uncertainty? Well, it's not the first time there's been this uncertainty. Again, with COVID, it is a different type of crisis because it's a global crisis, and it's one in which we don't actually have, a beginning and an end. But there are many things that we can learn from the past. And I think if I were to sort of start out on one that I think really merits a lot of discussion, where I think there can be some good recommendations, is we've been talking a lot about liquidity. And granted, there have been, in certain places, real issues with liquidity, and some other countries there have not been. Some countries have come through okay, as much as we know at the moment. And there is some discussion about where this is all going to end up. And, obviously from my equity background is, what kind of capital, requirements are going to, request some kind of capital raise from those investors. But, all in all, how do you cut through this? Well, that's part of it, is like, figuring out how is the liquidity, how is it going to be over the next year? How do you figure out what is the situation with the clients? What is going to be, what is their ability to repay? I think confusing this whole scenario right now is the fact there are moratoria that don't have a beginning and an end, or maybe they had a beginning and an end, but now they're not ending, they're being extended. And so, and there are multiple different ways in which regulators and others are responding to that. So what do you do? So I want to throw out this question of, what have we seen as a group? And then also want to hear from others in the audience that how best, or what are some ways in which, let's say in the case of Bosnia, how did you figure out, how clients were able to repay, or if they couldn't repay, would they be willing to pay at some point? Because that, I think, is the real trick.
Right. So thanks, Deborah. I would also, this was very pertinent also in Azerbaijan and in Palestine. I mean, I think you got to do a couple things. I mean, first of all, you can do it at the portfolio level risk. You can sit there and really understand, first do sectors. I think everybody's looking at sectors. Who's extreme, who's affected, by an extreme, in the high, medium, low, restaurants or tourism in Jordan, right? Or in Montenegro, where I'm working, or Jordan, those are extreme. And then you can segment it and think about it that way. You could also, you should do a COVID dashboard. I've been doing this with my clients and it's for the board, but it's also for management. For example, like for your loans that have, because now I'm also seeing restructures, right? Not only postponements of payments. So I've seen in some cases, postponement. Now we're restructuring, and we're giving them a 3 to 6 month grace period. So we're talking almost a year they haven't paid. Okay, we should be able to look at the restructuring and postponements, and then actually note which loans first payment they didn't make. If they don't make that first payment, that's really scary. And then you can do some heat maps, which I think we might show an example of later. So that's at the kind of the portfolio level to dive. And then you have to go to the individual loan risk. And that is really key. And that's retraining your staff, actually. And one thing we've done, and I did it in Bosnia, I've done it in many countries, we do kind of a qualitative questionnaire, very simple, for each customer about their repayment ability. And do they have other income? And their willingness to pay. Can we get them to give us, a little tiny bit of money every month? Because believe me, Bosnia, that saved our butts, excuse me. I mean, these guys were only for 2-3 years able to give us a little bit of payment, but boom, they got a job then. Or, they got another business going and they were able to make us bigger payments. And I want to say, and they set up, a very good collections department also. That's key. Really, it's very key right now because you will have a lot of people going into default, and it's understanding that willingness. And if you need to take the hard or the soft approach, soft meaning, okay, just give me $20 a month, and we'll talk and talk to them every month, and in 6 months, let's reevaluate things like that. Sorry, I've just thrown out a lot of things that I've seen work. So. Daniel, anything?
No, absolutely. I mean, I'm just constantly nodding my head, not because I'm falling asleep. You're absolutely right. So figuring out, and it is so specific to each client, right? This is totally client-centric, where, and what you're talking about, the dashboard is a way of saying, okay, if I figure out, okay, these clients are let's say like in a COVID scenario, you say these clients are actually in a sector that's doing pretty well, maybe in agriculture, or maybe something related to food production, something that's actually not as affected. Not by the way, restaurants, right? So, like grocery stores or something
right,
like that.
Not restaurants, no.
Exactly. That would be kind of one category. Then on the other hand, you would have categories that like, this is tourism. They got no money coming in at all, not from their old job. Maybe they got a new job because many, not a job, but an activity, right?
Right.
You see that a lot where, poor people by necessity are flexible, and they will do something else if they can make money doing something else. And you're seeing that. And I think you sort of see it in past crises as well, where people kind of, figure out something new to do and move on with it. But then aggregating those very specific client-centric assessments to the bigger pictures, like, okay, how many people do I have in this, higher risk category? How many people do I have in this, pretty good category is crucial. And that also sets you up for not just on the collection side, but also on the lending side.
Right.
Because you need to continue having that relationship, because if all you do is collections, that won't turn out very well. You might collect on some of those loans, but it's going to put you in a very, very bad situation when it comes to your solvency, when it comes to your liquidity. You have to have some way of getting new money out in order to maintain and continue that cash flow.
We should have a debate about that.
We should.
Because I'm not so sure I really think halting right now to new clients or very minimal, set a benchmark. The board should set a benchmark.
Yep.
Because I think it can be we have an MFI in Bosnia no longer here, big boy that is no longer here, and they were giving a lot of money during the last crisis, and I saw who they were giving it to, and I told investors, this guy is not doing well, and it's no longer.
What's interesting though, because I think looking back at the cases that we did, 10 years ago, and then the cases that we've done this year, which is, and again, you can go on the CFI website and see, in Palestine and in Azerbaijan and India and Nicaragua and others, is that in all those cases, they did keep on lending. So, and I think it was Ala Salam of Vitas Palestine who said, like, it was absolutely critical for us to keep on lending.
Right.
To new clients or to existing? To existing.
I'm
okay. I'm okay with existing. But to new clients or new products, you got to be very careful.
Well, it's true. I can even think though of a really interesting case. So I think the key point is to be very, very conscious if you're lending in the midst of crisis, that you're very clear of who you're lending to, what are these products, how are they going to perform?
Exactly.
Maybe you do it through a pilot at first. You kind of try.
Exactly.
So I'm thinking of one case that really comes to mind. So this goes back to 2000. Well, the financial crisis, 2010, 11. There was an MFI in Kazakhstan, and the majority of their business was lending to basically SMEs and kind of, just kind of the middle market, just small enough not to be interesting to banks, but kind of too big for most MFIs. That's kind of what was their target. And those guys were really hammered hard by the crisis because, for one thing, they had a lot of property, and the property market just cratered completely. So all of those loans that were used for housing were just not doing well. And so what this MFI did is they had one branch that was outside of the big city, and they were just starting out, just basically a pilot at that time. They're just starting out to do group lending, and it's something they didn't really know. They had been, but they were part of a network, and they had a sister organization in a nearby country, I think Kyrgyzstan, that had been doing group lending for a long time. And so the CEO, when the crisis started, she was actually visiting this sister MFI, and she had spent a few months there, came back and said, this is what we're going to do. So they started this group lending, and that is eventually what helped them get out of the hole. Because if they hadn't done it, they would have had no cash flow. They would have,
So one recommendation, I would say, when you start doing the new lending, you take it and you watch the par of that new lending.
Absolutely.
And if there should not be a delinquent loan there. And
Absolutely.
if there is, I would beat up that loan officer and beat up that branch manager. So you got to monitor that separately. The other thing I should have mentioned is MIS is key here, because when you have these, you can actually develop a risk rating for clients to say they can pay, they can make a partial payment, they can't pay anything, and it should be put in the MIS system, also with comments of the client's repayment ability. So then senior management, they can be monitoring that and watching what staff is doing. So MIS was very key in a couple of the MFIs I worked with also. But okay, maybe new products can, but monitor them.
Yes, lend but carefully.
I mean, I think the case of
and I would actually maybe even emphasize that the monitoring should be like, don't look at par 30 or let alone par 90. Like, you look at the payments as they come in.
Right.
Yeah, so it's really this very intensive monitoring where you're looking at the loans as they're performing now.
They shouldn't be one day late.
I agree 100%.
Yeah. And that information is not always easy. I mean, from a point of view of an investor, that's really what you want to know. You really want to know collection rates, but it's been, it's quite easy it's normal to be looking at par as well. And that is actually also what, gets reported often. So I think the situation that from an investor point of view is it's very hard to know what's going on. I mean, unless you are spending, half your life probably inside this trying to get that information. So it is tough right now to figure out what is happening, but it is the collection aspect that is key and probably, really requires hands-on TF, which means, as you alluded to earlier, Donna, that you need to make sure your staff is up to it. I mean, that's not necessarily what they've spent their entire life doing, focusing on that element.
Yeah, but I work with a great person who can take you give her an Excel sheet of all the portfolio, and we've done it because we've been doing stress testing for MFIs in the Balkans, stressing their balance sheets out with based on the economic data. And, with pivot tables, you can do a lot. So if they have a good analyst, some young, thing, because I'm not good at it. I gotta be honest, pivot tables scare the heck out of me. But somebody else who can pivot and get all the data, you can slice and dice your portfolio. But yeah, they've got to have, they also have to be getting that data and asking for it. But yeah, repayment rates, I've had some MFIs are able to give it to me very easily, and some, interestingly, have not. But if I was a board member, that's what I'd want. And I want a COVID dashboard, and I would tell them, tell them exactly this is what we need to be looking at.
Right. And also, I think if there's a kind of a common theme, I would say it's the analytics applied to the data is crucial. So, depending on the situation, you might be looking at a particular group of clients. You might be looking at a particular vintage of loans. Okay, loans made since April. How have they done? Right? Things like that. And you
Right.
just have to, that almost regardless of what your system is, the underlying MIS, that data is there. You just need to have the ability to pull it out of the system and then put it in the format that you can analyze it.
Manipulate
And
it,
you're
right?
right,
And
you can go far with the basic tools like Excel.
oh yeah.
You don't have to go and start spending a lot on reporting systems. I mean, if you have them, great, but that's not the time to start building them. I think you use the tools you have, and I think, Donna, you point this out earlier, is like, keep it simple, like
Well,
the
oh
process.
yeah. Keep it simple. But like with my analysis we've been doing with MFIs now, of course, the data is only going to show you there is something there. And then you got to dig a little bit deeper,
Yes,
right?
exactly.
And so if we start seeing postponed loans that can't make that first payment, or restructures, even worse, we haven't done the correct analysis. And then what analysis did we not do correctly? Or did something happen with the clients? So that's when you have to go deeper. And that's where you're going to have to look at the individual loan, assessment and really understand this. And what's key in any crisis right now is other income also, because maybe either the business is not operating or it's operating at much less, but you've got to look if there's other income in the family. I'm not saying we take it all. I mean, we've got to we've got to be sensitive to the needs, but we can do an analysis and really understand how much can they give us for a while until the situation changes or a vaccine comes.
Right. But I mean, also in your case, you're also, the issue is, how do you tell if a client is going to be willing to pay, even if they can't pay now? So it's like, how do you really slice and dice? That's an issue also of just trusting,
Well, no, it's also training I've seen training loan officers ask the right questions, giving them training them. That's what I did in Bosnia. We trained them and trained them and trained them again, and had people go out and check, to double check if these people can't pay anything. And, it's asking the right questions the right way and talking to them the right way and understanding if you need to be hard or soft. And not everybody can be trained, to be quite honest. Not everybody has that talent. I'm usually just tough.
That's why you're on the collection side.
That's why I'm on the risk management side. Exactly.
That's right.
So I think this would be a good time to talk a little bit about the heat map, because I think there have been a few inquiries a little bit.
Yeah,
let me get a little bit more into detail as to what you've done.
Put it up? Yeah.
Can we do it like this?
Okay, it's hard. It's a little hard to see. Is that
let me. I think I can zoom in a bit.
Sorry,
no. So how about?
So this is a really simple tool. Yeah, great. So if everyone can see, there's categories A to E, and then 1, 2, 3, and everybody can see the A, B, C, D, E is actually days late. Okay, it's the buckets that we have per se. And then the 1, 2, 3, 4 are the low, medium, high, extreme impact sectors. Okay, so your MFI, here's a couple things, that you need to do is that then, in credit risk and risk management is going to have to go and say, which sectors have been hot, extremely impacted. Those are going to be the ones that were shut down or still shut down, like tourism in a lot of places or restaurants. And then where's the low impact? So I've been doing this with a number of MFIs, and I think, Daniel, you mentioned ag. Yeah, ag is always, it seems like it's been performing and it's low impact. And extreme has been the tourism, the restaurants. In some countries, construction was hit. Some countries, construction wasn't hit. So it just depends, really country to country. So then you can put that in, and then you can monitor this to see. And then you see that the top one is the actual. I don't think it's dollar amount. It's the local currency amount. I change those numbers, and then one below is percentages. And then you can just kind of monitor this. You shouldn't see low impacted going days late, right? Let's be honest, they probably have money coming in. You should try to understand, if you see that increasing, why that has happened. And then the high impact you might see going, bucket to bucket. You could also interestingly do this by repayment rates also. Are they, repaying 50% of a payment or 25% of a payment or 75% of a payment? You could also then do a heat map, a subsector, and on repayment rates, and watch every month that they're able to at least, you have an agreement with them to make 25% payment of what their payment is. And then you should be able to slice and dice your portfolio every month, see how much they paid, 0%, 25%, 50%, and you should be able to look at the subsectors, because you would hope your greens are paying, 75 to 100, your orange hopefully 50, and then your reds, well, if you can get 25% out of them, you're probably happy with that. So that's kind of, it's a very simple tool.
Yep. Yeah. But I think sort of the key message would be beware of averages. You want to get to the, you don't want the average to be a combination of good and bad. You want to see everything kind of in the one family that's relevant, and whatever that grouping happens to be. And if, for example, let's say your initial assessment of a sector was off and you had categorized a whole bunch of clients in the wrong sector, in fact, they are much more affected than you thought, you probably want to pull them out and put them in a separate one. Like don't let, you kind of, and that kind of gives you the full picture in that sense.
Right. I mean, tied to this, which I'm not showing you, is a list of all the sectors, and we grouped a bunch of them and put them then if they were red, orange, or green, or high, medium, low, or impact. Also then it did, I have some MFIs I worked with that were fantastic. They had, 50 subsectors, and it worked out. I had one that has 500 loans in 258 sectors. Yeah, I mean, that was, a bit of a nightmare to tangle through, and another one had, 25% of the portfolio is other. And we're like, oh, what's in that? Because, this is only as good as the data that's going in. So if you're a board member looking at this, or a senior manager, you also have to see the subsectors next to it and make sure they also make sense.
But I would say, Donna, I mean, to some extent, let's say if your data isn't that great going into it, that was maybe you didn't really emphasize the loan officers when they were disbursing loans to make sure you put the right sector in. And so there's all kinds of junk in there. I would imagine that there's probably, at a minimum, one, you can review it and recategorize. It takes a little bit of work, but, loan officers got to do something, and they're not disbursing lots of new loans. So they might as well be doing recategorizing existing ones. And then the other one is, as you're monitoring and seeing payments coming in, I would use that information as a category itself. Okay, all the loans have made their payments in both September and October in this group. Can I see something about this group, and there's something specific, and then those that aren't, etc. So you already can kind of monitor. I'm just always wary of grouping a bunch of things in one category and then looking at an average, because it's not actually telling you anything you can act on.
Right, exactly. Yeah.
So I have it's something related to this in terms of how the activities of the staff is, in so many financial service providers, staff incentives are based on making new loans and collecting them as well, or maintaining good delinquency. But I know in one of our cases, we saw that the financial service provider changed dramatically the incentive structure, or the variable versus fixed part of the salary to obviously incentivize staff to focus on collection, or get reoriented towards their activities. I don't know if either one of you have a comment on that front.
Yeah, you got to be careful about it. I mean, we also incentivize them on that they were putting in correct data, that the information, like they had to be putting in, again, MIS, I'm going to push this, but, they should be putting in comments every time they contact the client, and the status of what's happening. And if they're not making a payment, when they think they can make a payment. And so we were also giving them incentive to make sure that they were filling this in all the time, that it was, and then when it was, when their manager went and actually called some clients, it was actually tested correctly, because that's also important to make sure, payments are coming in, but there should be a little bit on getting them to also make sure they're documenting and writing things in. So that was another piece I saw, and Daniel?
I just want to make sure, there's a whole other level to all of this, right? We're talking about portfolio, we're talking about clients, we're talking about, making sure that money's coming in, right? But then there's the other side of, okay, how are you managing your liquidity? How are you managing your solvency? Like on a purely the financial side. And obviously the two are completely linked. But to me, I mean, one thing that I found really relevant is, so first of all, why are we so keen on repayments is because, well, obviously that directly affects both your solvency and liquidity. And that's one of the reasons I was talking about earlier, why it's important to continue lending, because that's what's going to make sure that there's money coming in. Because if you don't have new money coming in, then you're going to be in some trouble. The other issue is, if you go back to kind of the early parts of the COVID crisis, and in fact this was discussed in the opening plenary, there was one of the findings was that I forget who it was. I think it was Eric Campo from Grameen Credit Agricole. He was talking about what they were finding is actually the number of MFIs that are really suffering in the liquidity crisis right now is pretty small. Like that was a real big concern going back in April and May, and now it's kind of settled down, and it's really, they're just looking at there are a handful that are still kind of suffering, but it's not the big issue, and there's a much bigger emphasis on solvency and how are things going to look, like, once loans get off moratorium, what's my portfolio going to look like? How much write-off am I going to have to take? And I think there are some interesting points in kind of to look back how other MFIs, some of the ones we have drawn for these case studies, have had write-offs that reached, 20, even 30%. There was one of the case studies I calculated, they wound up writing off over 40%, I think about 42, 43% of their outstanding portfolio at the peak. So if you take the sort of the onset of the crisis, and you look, over the next 7-8 years, they wound up writing off that much. And it was just, they stretched it out because they had no choice. But that is you can actually wind up having massive write-offs of that level and still survive. But I just wanted to put it out there to make sure we don't forget, because I think people are interested.
But I also think it's difficult right now. I mean, this is what I was saying, that everybody's in a bit of a fog, right? Because we're in this world of moratoria, so it's hard to know what's real or not real. I mean, investors, are trying to figure out what are our estimated losses going to be, because there's losses, and then there's going to be, well, and what kind of capital is going to be required. And I think there is, a concern that there will be inevitable consolidation that happens as a result. You also need then to take into account, to use a phrase, the ecosystem in which you're operating. What is the viewpoint of the regulators? How engaged are they? How engaged are investors or board members to really understand what is coming down the pike? I think what's making people nervous is that with moratoria changing, going back and forth, in some countries, some of these financial service providers are going to look pretty good because they haven't had to write off anything. It's not going to be a reflection of reality. 2020 is going to look like a great year, which is, it's laughable. So I think that's the question. How do you dig deeper to know what's really going on? That I think is the big challenge right now. So it could be liquidity, and it's certainly, I think solvency is on everyone's mind.
These stress testing have scared the hell out of me. I mean, of the hell out of me, because, and I've only been doing them in the Balkans, but I see, the delinquency rates, the write-off rates are coming in 2021. They're coming. That doesn't mean that these MFIs won't survive, and that doesn't mean, but they're coming. It's just going to see how much the repayment rates, so for me, I think we talked about this before. I've been trying to forecast a budget with some MFIs. It's a nightmare right now, but I'm sorry, it should be very simple right now. There's some great tools out there, budgeting tools, but they're too elaborate to use right now. All you need to know is, are your investors going to be patient? Which you guys are being much more patient this time. More than in Azerbaijan, really, you guys were breathing down our necks back in 2009 and 10. So you're patient, which is great. Thank you. But we just don't know the repayment rate. So we need flexibility in any kind of forecasting tool to say, okay, are they going to roll over their debts? Number one. And two, I got to be able to look at if my postponed loans only repay 50% a month, or if they're going to pay 75. And then I can make my decisions on disbursements, because we're also been doing liquidity over 12 months in these stress testing. And, we do a medium and a high stress scenario. And, under the high stress, most of the MFIs have had to say, under a high stress, we are not going to be dispersing as much as we plan to. Mm. So, planning in a fog, but you don't need to be. You really can, under risk management, there should be no surprises. So you need to look at a high, extreme, medium, and low, and have all those and give those to the board and management and think this out. Okay, we'll cut disbursements if we need to here. We'll ask for deferments here from our lenders if we need to under the extreme case. You be ready.
But, this is also predicated on, regulators or others, whether or not you're going to need to raise your capital. And then we've never been faced by a situation in which there will be a global demand. For the most part, these crises have been, country specific or region specific. So, you're now asking equity investors to be perhaps, ponying up a lot of money, in a lot of institutions across a lot of countries. And I think it's definitely an unknown, I think, an uncertainty right now as to whether there's really enough money to support that. So that, I think, is an element that we haven't seen in the past.
Again, it's going to depend, on these countries. First of all, the stress testing I've seen, to be quite honest, the ones that had good capital, the beginning strong capital, are going to be fine. They're going to go down and they're going to hit that 20%, right, that you guys all want. But they're going to be okay. The ones that started at 20, yeah, those are going to be the ones that are going to have a problem. Now, let's be honest. In Bosnia, the MFI I walked into was probably near insolvent on paper. But they had restructured everything. Now, those were dead loans sitting there, but they had to. But also, we don't have regulators that are regulating and breathing down your neck. So it also, right, are the regulators going to come in and say, you're below 20, close up? Or to below 10, close the doors? Or are they going to look the other way? Or are they not, is their CAR not, their capital adequacy ratio even monitored by regulators? Right. Many countries, they're not, Yeah. So there's MFIs I've seen in 2 crises that were insolvent probably on paper, but they survived and they did fine.
Right. Well, I have to say, I tend to be more on the somewhat skeptical side when I look at capital adequacy ratios in the midst of crisis, because the number of times I've seen capital be very close to zero but not actually below is far larger than one would randomly expect. And I mean, I've seen MFIs to say, oh, okay, well, we would normally provision for these loans, but we can't, so we won't, and we'll under provision, and they sort of stretch it out, and
Exactly.
and I think. And I think that's fine, actually. I would imagine that most regulators would not be willing to go ahead and shut down multiple institutions all at once. Like, it doesn't help them any as a regulator to do it. So if there's, for example, 1 or 2 that are doing really badly, but the rest of the market is fine, then maybe they will. And so I think the real issue is on, if you have poor performers in the market that really stand out from the rest of the market, who knows what their ultimate situation will be? It may in fact be bankruptcy. But if the whole market is doing poorly, I would imagine that regulators will be basically forced to have forbearance, because you're not going to close up everybody, and it also forces creditors to be in the chairs like, yeah, we're going to have haircuts, because what else are we going to do? It's like, we're going to accept some of our loans will being converted into equity, because it's not as if we have any other choice. But one of the cases was Spandana in India. They did exactly that. They had they basically took the entirety of, so going into the crisis, half of their portfolio is Andhra Pradesh. Andhra Pradesh is closed down. Their repayment rate is basically 0. It's less than 1%, not delinquency, less than 1% repayment. for half of their portfolio. And that kind of was like this for a long time. Ultimately, they wound up recovering something on the order of about 15% of the portfolio that had been outstanding. So it wasn't complete 100%, but it was close. And from what they worked out with the regulator was to force existing bondholders or creditors to accept what I forget the technical term is. I think CDR, but I forget what it stands for.
Corporate debt restructuring.
It converted it. It was a credit restructuring process, and it converted the amount of debt that was equivalent to a standing non-paying portfolio into equity-like holdings. So it was. So it was. I think preferential equity, where it was still paid out if so long as they could pay it. It wasn't. But but that's what you're gonna wind up. Nobody wants to talk about it, but I think for those markets that are really, really hard hit, I can imagine this will happen.
Deborah, you bring up a good point about the regulators. I would think from the equity standpoint, you must be doing some country risk analysis, right?
Yeah. Without a doubt. And I think the other thing to remember is that, equity investors do not have an unlimited pool of money. I mean, they have, a lot of these microfinance investment vehicles have not a lot, but a certain percentage are limited life. So to some extent, you've got funds that are coming to the end of their life. They may be fully dispersed and they are not able to give more. So you have a lot of interesting negotiations that will be happening and are happening about what happens now when there's a need to raise capital.
Right.
And so, or you've got to decide which institutions you're going to support in which country. So, I mean, there's these very difficult sort of triage-like situations that I don't believe we've really seen in the past. And and indeed, investors are being patient, but at the same time, it's, on their end where their money's coming from, it's limited. Yeah. So I think it's not, a situation of a debt investor that has to roll over and restructure and has actually had some experience in doing a lot of debt restructuring, which maybe 10, 15 years ago, people hadn't. But this is a kind of a different situation. And you are looking at which countries are really your priority countries.
Well, and I also think investors and MFIs and CEOs, let me tell you, when I tell them this, they do not like to hear this right now. I say, you've got to be ready to be smaller. You're going to be smaller, and it's okay. Just survive the next year. If you get, decreased by 10%, even 20%, you're going to be okay. But, and believe me, it's funny. CEOs do not like to hear that. CFOs are okay with it, but CEOs are always, their hair gets up on the back of their neck. We can't go smaller. And like, yes, you can. Just survive.
That's the beauty of these case studies that we're writing. They've all gone smaller. Smaller, and then they did fine.
Right, yes. Exactly.
And what was interesting is none of them, as far as I know, got infusion of equity during crisis period. So in my sense is, I would be surprised if there were significant equity injected into struggling companies. What investors are going to do is they're going to wait around, see, are they going to be around? Are they fine? And once they're ready to start growing, then they will inject equity. But that could be 3-4 years from now. Yeah. I don't see a lot of equity coming into the market next year. I mean, who knows? If it's really rapid, maybe.
Yeah, I agree.
Smaller.
I agree.
But this is the interesting thing is that, there was one case we haven't yet published, but we will, where they shrank to half their size, and they were not the hardest hit institution in the country. They didn't even have, their write-offs weren't so terrible. I think they wound up hitting 12, 15% of their peak portfolio was written off. This was a MFI in Bosnia. And they shrank, and they kind of knew that was coming, and they went ahead and prepared for it. And one thing that I found really interesting, and I don't think we really mentioned it, but kind of throughout all of this is, like, as we're talking, is like, okay, what's coming down the pike? What's happening? What are you seeing in your portfolio? All of that, the MFIs that have been successful, they've all been very, very transparent to their investors and to the regulators if needed. That wasn't necessary in all countries, but very transparent is like, how are they doing and what's happening? And that, I think, made a big difference in investors and being ready to kind of work with them and provide the flexibility that they needed and extend their debts if that was what they needed. But I think this is, for me, it's a common theme across sort of successful survivors of crisis is like those who are not transparent tend not to survive.
Mm.
You
Yeah.
know, you
Right.
can't hide it.
Right.
Mhm.
Exactly.
No, exactly.
All right. So I think this is a good time for us to wrap it up because we're gonna bring Ivo in. But Deborah, maybe you want to just conclude a bit, some concluding words.
No, I mean, I think that, you know, I mean, every case is different, but I think there is a lot to be learned by looking at past crises and reaching out to people like Donna and others who've gone through it. I think sometimes, just like many CEOs feel like they're alone at the top, there actually are a lot of people available and a lot of resources. And so I think the point of this discussion was really just to raise a few points, bring up a few issues, and direct you to some resources. So hopefully you can read the case studies. You've seen Donna's heat map, but I think that's and be optimistic, because all of these institutions did survive and turn
Yeah.
around. So,
Mhm.
but they all had to make really hard decisions,
Yeah,
Exactly.
and they
absolutely.
benefited from having supportive investors and supportive regulators. So it can't just be you. I think you need to be engaged with everyone.
Great. And just for the audience, in the just below the window, you will find a link to in the description. You'll find a link to all the case studies that I've been talking about, and you just follow the link, and there'll be many more links that will take you because the kind of one is linked to the next, and so on. But there's lots of research out there that you can consult, and hopefully we can help out with that. So.
And I just want to quickly add from a question that someone had. I'm not saying that I think equity investors will play their role. Someone asked to accompany a turnaround. I think it may not be as quick as some people want it to be because of the ability to sit back and sort of analyze and see what's going on in the future. But the equity investors are very committed. It's just trying to figure out the extent of the losses.
Yeah. I see. Yeah, I see the question. I mean, my feeling is regulations matter only if they're enforced. So, strength in numbers. If you're the only institution, then you're in trouble. If you're one of 10, you'll be fine. It doesn't matter where your numbers are. That's my personal feeling. So, anyway, thank you. We're gonna trade roles, Deborah. Now I'm gonna take over as the moderator. We'll bring Ivo in. Donna, Deborah, it's been a pleasure, and we'll see you around. All right. So, Ivo, you were backstage listening to all of this fun, but you didn't get to take part. But it's nice to have you, and maybe a quick sort of update of why you've been working on this paper at CGAP called you called it a crisis management roadmap, right? But specific to COVID, and so. Maybe you can just briefly introduce yourself, and then we can go through a few questions so you can describe the work you've been doing.
Thank you, Daniel, and thanks for having me. Also, thanks for letting me to listen to this very, very interesting conversation. I think very practical, many important points raised, so I thoroughly enjoyed it. My name is Ivo Jenik. I'm financial sector specialist at CGAP, and I've been working mostly on policy issues, things around digital financial services, innovation in business models. But since the pandemic started, I focused a lot of my attention to the response to the microfinance industry and the project that we called Crisis Management Roadmap.
Okay, great. I will need to share screens again and bring this up. But while I do, Ivo, so in response to COVID-19, you've done at CGAP had several sort of responses, and one of them is this publication. So maybe can you briefly talk about how that fits within this broader agenda that CGAP has been working on to respond to COVID?
Yeah, absolutely. We basically faced a very difficult decision, as many other organizations at the beginning of this year or in the springtime, of what to do, how to respond to the pandemic, because nobody really knew how long it will take. Nobody really knew how it will evolve. And we were in the middle of our fiscal year trying to figure out whether we should continue our agenda as planned or whether we need to do something in response to the pandemic. And we decided to go back to the roots and refocus part of our attention to the response and supporting the microfinance industry. I'm saying to the roots because you know that CGAP was established 25 years ago to coordinate stakeholders in the microfinance industry in support of the microfinance. But since then, we've moved more towards the digital financial services, mobile money, and so on. But we thought, well, this was a good time where CGAP could again bring the expertise and contribute to the global effort to support the microfinance industry. And so we've created 3 major working groups or technical groups. One was focused on is focused on investor alignment and coordination. And I think we heard quite a bit from both Donna and Deborah, and actually you, about how important it is for investors to be patient and to coordinate, and that the global demand for investment and capital might be a challenge. So we also recognized that and wanted to convene our members and partner organizations who can just use CGAP as a platform to exchange experiences and coordinate their steps so that we kind of lean towards the positive equilibrium rather than the negative one. Then we launched a pulse survey, which was an early effort to collect information about what's happening around the world and where the industry stands and how it is evolving. So I think we got a pretty good response ratio at the early stages, and we were able to establish some sort of a snapshot of the situation and monitor it over the time. And I think yesterday my colleague Peter Zetterly was probably talking about the challenges of running the survey and collecting data during times like these. And then the third work stream or technical group that I have been leading was labeled as resilience, but it was really about, or it is about, first of all, helping microfinance industry just to navigate the crisis and survive, as we talked about it. What are the steps that you need to take to survive? But also think about this crisis as an opportunity to maybe advance some of the long overdue agenda around digitization, around changes in the business model. And so in this resilience technical group, one work focused on debt restructuring and investor relations, one focused on digitization, and we can maybe touch upon that very briefly. And then the third one was the crisis management roadmap.
Great. Well, I will maybe show you have a couple of slides to share, but first, so you titled this crisis management roadmap, right? But when you think of COVID, do you see it as being similar to a crisis before, or is it something really completely new?
So, Daniel, I when I was listening to the conversation, I was just kind of in my mind ticking the boxes as we lay them down in the roadmap, because the crisis is new in so many different ways, but it's also known in so many different ways. So what I'm basically saying is what we've heard from you and Donna and Deborah, that there are lessons from the past that can be applied today, because it is crisis, and as such, microfinance institutions need to focus on things like liquidity, solvency, portfolio segmentations, debt restructuring, when to resume lending to the existing clients, when to resume lending to the new clients. So all these things are known, and there are lessons from the past that can be applied. But then again, as we've heard, there are so many idiosyncrasies that are related to this pandemic, one of which, or all of which, are related to the simple fact that it's evolving. And internally, when we discussed this, we with Julie Abrams, who's the author of the roadmap, she kind of came up with this proxy description that it's a comparison between a photograph and a motion picture. Previous crises, many of them are like a photograph. Something happens, earthquake, flood, drought, political disruptions. Then you assess the situation and you decide the way forward, right? In this case, it's a motion picture. Things are happening, and especially in spring, everybody remembers that every day has brought something new, something to which you would need to react: lockdowns, new government measures, moratoria, and so on and so forth. And so that makes the crisis very different. And the other thing worth highlighting is the global nature. So it's not only that there is a global demand for capital, but it has implications for every stakeholder involved in the industry. It really affects everyone. We see it with microfinance networks. You know, they cannot really focus their attention to one particular region or country. They need to look globally what's happening with their members. And the same is true for clients. The same is true for the microfinance institutions themselves. So there's a lot of these specific issues, and the way we addressed it at a very high level is just taking the lessons from the past and interpreting them in this new context.
Okay, great. So, in fact, maybe you can help us walk us through a little bit through the roadmap. I'll go ahead and add it. So, tell us what this is.
Yes. So this is just illustration, to be honest. But the roadmap, if you look at it, is meant to help microfinance industry and stakeholders find where they are as of now and what kind of lies ahead of them and what are the steps that they might have missed in the past and may want to get back to and implement. But let me say first that it's not a product that we created on our own with CGAP. What we did was that we reviewed close to 200 tools, guidances, and documents that already exist out there from the previous crisis, but also from now concerning the COVID. And we triaged them into different topical categories. And then we linked them to specific crisis management actions. And so what you get with the roadmap is basically a list of actions, immediate ones and long-term ones, milestones, and then references to other resources where you can learn more about what to do. So let me give you an example. A business continuity plan, for instance. We talk about business continuity plan in the context of COVID, and we unwind it into different specific steps: ensuring safety of staff, ensuring safety of customers, changing the operational models or tweaking it. But then we provide a checklist. Basically, this is what you need to do if you want to ensure staff safety under the COVID scenario. And if you want to learn more about those specific steps, then we provide you with references to other resources. And Daniel, your name is all over the document, trust me, and Dona's and Deborah's as well, because you guys, you've done so much great work, and there are so many publications that are already so useful that we didn't want to recreate them. We rather wanted to make it easier for the audience to find them and find them at the point where they need it. So that's how the roadmap is meant to work. And maybe one more word is that when we thought about the audience, we thought about rather local, smaller or mid-size microfinance institutions who are not necessarily connected to the big international networks or who don't necessarily have access to big international investors. But who want to learn about the international practice and learn from those bigger players about what they do and what they've been doing in crisis. And so we're trying to intermediate the knowledge.
Great. Well, thanks very much, Ivo. And I see we have a comment from Davide Castellani, sort of talking about that compared to previous crises. The one, and you emphasized as well, is that what comes with it, its global nature also requires global coordination, which is, I think, partly what this roadmap is meant to do, and all the work that investors have been doing, and the work that I know AFI has been doing with central banks on the regulatory side. So there's a lot of coordination happening across the sector, and I would even say some of what we're doing here during Microfinance Week is part of that coordination, right? It's sort of sharing examples and lessons that are relevant to stakeholders who might not otherwise have heard about it, right? If you are an MFI in Guatemala, you may not have known that Azerbaijan went through something 5 years ago. So this is, I think, one of the reasons it's kind of helpful to do this. So on that note, I think we're coming to the very last minute. So I just wanted to thank Donna and Deborah and yourself, Ivo. I think it's been really a great opportunity to have this discussion. I would just note to the audience, if you have any questions, follow-ups, there's a wealth of publications. I know. When is the roadmap coming out, Ivo? It's not published yet?
So great question. The roadmap, it will be published in 2 weeks or so. So beginning of December. Yeah.
All right. So it's coming right up. The CFI has a lot of publications. We have in partnership with CFI, we have quite a few publications on the COVID-finclusion.org website. And if you need a real crisis management expert, we can tell you how to get in touch with Donna as well. So we are a network, and that's kind of our job. So we don't mind the calls. All right. Well, thanks very much, and I hope you enjoy the rest of the conference.
Thank you, Daniel.
Thank you, Ivo.
It's time for another break. Please come back in 15 for the last part of our program for today.